Want to earn money while you sleep? Dividend stocks can make it happen. These are shares of companies that pay you a portion of their profits, usually every quarter, just for owning them. Think of it as getting paid to hold on to an asset that can also grow in value over time. In this video, we'll break down how to find reliable dividend-paying companies, what yield really means, and how to build a portfolio that generates steady passive income year after year. Today we will talk about how to invest in dividend stocks. So before we start, make sure to hit the like button and subscribe to my channel. 1. The fundamentals of dividend stocks. A dividend stock is a share of a company that pays out a portion of its earnings to its shareholders, usually in the form of cash. These payments, known as dividends, are a way for companies to share their profits with investors. Unlike growth stocks, which are companies that reinvest most or all of their profits back into the business to fuel expansion, dividend-paying companies are typically more mature, financially stable businesses with a consistent history of generating profits. For an investor, dividends provide a regular stream of income that can be taken as cash or reinvested to buy more shares. This makes dividend stocks a popular choice for investors who are looking for a combination of income and long-term capital appreciation. 2. Why invest in dividend stocks? Investing in dividend stocks offers several distinct advantages. The most obvious is the creation of a passive income stream. This can be particularly appealing to retirees or those nearing retirement who need a consistent source of income to cover living expenses. The income is often predictable, with many companies paying dividends on a quarterly basis, and some even monthly. Another major benefit is the potential for compounding growth. When you reinvest your dividends, you're using that income to buy more shares of the stock. This, in turn, means you'll receive even more dividends in the next payout, which you can then reinvest again. This cycle of reinvestment and growth can significantly increase your total returns over time, often leading to a much larger portfolio value than if you had simply taken the cash. Finally, dividend stocks generally exhibit lower volatility compared to growth stocks. The companies that pay consistent dividends are often well-established and have a history of weathering economic downturns, which can provide a sense of stability and act as a cushion during market volatility. 3. Key metrics for evaluating dividend stocks. Before you invest, you need to know how to properly vet a dividend stock. Simply chasing the highest dividend yield can be a trap. Instead, a successful strategy involves analyzing a few key metrics to ensure the company's dividend is safe and sustainable. The first is the dividend yield, which is the annual dividend per share divided by the current stock price. While a high yield can be attractive, a yield that is significantly higher than its peers might signal that the stock price has fallen due to a serious problem within the company, potentially leading to a dividend cut. The payout ratio is another crucial metric. It's the percentage of a company's earnings or free cash flow that is paid out as dividends. A low payout ratio, under 50%, is generally considered healthy, as it shows the company has plenty of earnings to cover its dividend payments and also has room to grow the dividend in the future. A very high payout ratio, over 80%, can be a red flag, suggesting the dividend may not be sustainable. You should also look at the company's dividend history to see if it has a track record of consistently paying and increasing its dividends, even during recessions. 4. The difference between high yield and dividend growth stocks. Not all dividend stocks are created equal, and understanding the different types can help you align your investments with your personal goals. High-yield stocks are companies that offer a large dividend yield relative to their stock price. These can be attractive for investors who are primarily focused on generating a high level of current income. However, they can also come with higher risk, as a high yield might be a sign of a struggling business. It is crucial to examine the fundamentals of these companies to ensure the dividend is secure. On the other hand, dividend growth stocks are companies that may not have the highest yield today, but have a long history of increasing their dividend payments year after year. These companies are often financially strong, and their rising dividends can outpace inflation, which is a significant advantage for long-term investors. A well-known group in this category are the dividend aristocrats, companies in the S&P 500 that have increased their dividends for at least 25 consecutive years. 5. Building a diversified dividend portfolio. A well-constructed portfolio is essential for managing risk. You should avoid concentrating your investments in just a few stocks or a single sector. A good strategy is to hold between 20 and 60 stocks to reduce company-specific risk. This ensures that a problem with any one company won't have a devastating impact on your overall portfolio. Diversification should also extend across different sectors. For example, you could include stocks from stable sectors like utilities and consumer staples, as well as companies from more cyclical sectors like industrials and financials. This approach helps to smooth out returns, as some sectors may perform well while others are struggling. You can also achieve diversification by investing in dividend-focused exchange-traded funds, ETFs, or mutual funds. These funds hold a basket of many different dividend stocks, providing instant diversification with a single purchase. 6. Dividend reinvestment plans, DRIPs. One of the most powerful strategies for building wealth with dividend stocks is to utilize a dividend reinvestment plan, DRIP. A DRIP is a program offered by a company or a brokerage firm that automatically reinvests your dividend payments back into the same stock. Instead of receiving cash, you receive additional shares of the stock, often at no commission. This process supercharges the effects of compounding, as your dividend income is immediately put to work to generate more earnings. Many DRIPs also allow you to buy fractional shares, ensuring that every dollar of your dividend payment is used to acquire more of the company's stock. Over a long period, this can lead to substantial growth in your portfolio. You can set up a DRIP with most major brokerage firms, or you can check if a company offers its own direct purchase plan. 7. The tax implications of dividends. It's important to understand the tax implications of dividend income, as they can impact your overall return. Dividends are generally categorized as either qualified or non-qualified ordinary. Qualified dividends are taxed at the lower long-term capital gains tax rates, which are typically more favorable than ordinary income tax rates. To be considered a qualified dividend, you must have held the stock for a specific period of time, typically more than 60 days during the 121-day period surrounding the ex-dividend date. Non-qualified dividends are taxed at your regular income tax rate, which is often higher. The payer of the dividend will typically provide you with a Form 1099 DIV at the end of the year, which will specify whether the dividends you received were qualified or ordinary. 8. Putting it all together. A step-by-step approach. To begin investing in dividend stocks, the first step is to open a brokerage account. This will be the platform you use to buy and sell stocks. Next, you need to define your investment goals and risk tolerance. Are you focused on generating immediate income, or are you looking for long-term dividend growth? Your answer will influence your strategy. Once you've established your goals, you can begin the process of researching and selecting stocks. Use the key metrics discussed earlier, dividend yield, payout ratio, and dividend history, to identify stable, well-managed companies. Consider starting with established companies known for their reliable dividends, such as those that are part of the dividend aristocrats. If you like this video and would like to see more like it, please give it the thumbs up. Leave a comment and click the button to subscribe.